Hi guys, Chris here with Super Savvy Travelers, and we're so excited because we have Nick Metta from Studio Legale Metta here with us today. And as you know, if you've gone back and looked at the videos that we've done in the past with Nick, they are absolute pure gold gems. This is really, really good information. So today we're going to discuss some of the things that really a lot of people have on their mind. So check it out. Hi Nick, how are you?
Good. Hi, how are you?
We're doing great, thanks. We're so happy to see you. So we've got a lot to talk about.
Thank you so much. Yeah, thanks for having me. Absolutely. I'm excited.
Yeah, me too. The thing that excites me the most, I remember about a month ago, we had a discussion on taxation. When people come over to Italy and they're there, part of the time or most of the time even, we talked about the hierarchy and the sort of, how do you know whether to pay taxes in Italy or in the US? And we went over that in great detail, and I thought it would be really, really handy for our guys to understand. Can you give us an overview on that?
Yes, definitely. It is an incredibly um, miss, or I would say underrated topic. And it is extremely important to actually think about it because many people live in Italy and they think that they don't have any obligation, whereas actually they are actually breaking tax rules and they without knowing it. And so they are in a situation where they might have to be, they might receive tax assessments, penalties, and which might be extremely concerning and penalizing monetarily. So the main mistake that many people do is thinking that since there is a treaty against double taxation between Italy and their home country, they can pay the tax in their home country, and that way they satisfy the requirements for tax purposes because there is the treaty that prevents and it is against double taxation. But actually, when you are in a situation where you move to another country, you want to look at the treaty. And what the treaty does, the treaty establishes rules of taxation in terms of precedence and exclusivity, meaning the treaty says if a person that has income in country A moves to country B, that person has to pay the taxes on income that is generated in country A in country B. Or the treaty might say that the taxes must be paid in country A. However, there are many types of income, and the treaty, when there is a treaty against double taxation, a treaty will go through each category of income. Can be employment income, can be dividends, interest, royalties, real estate income. So depending on the type of income, the treaty will establish if there is precedence, meaning the taxes are paid first. For example, let's take an example, that probably perhaps viewers will be familiar with, which is real estate. Let's say an American buys a piece of real estate in Italy, and they live in the US, and occasionally they rent the property in Italy on Airbnb, let's say. So short term rent. They will report that income in their US tax return. However, the treaty says that when there is rental income, real estate income, taxes need to be paid first in the country where that real estate is located.
Mhm.
So even if you live in the US and own a property in Italy, you still have to pay in Italy the taxes that Italy charges on rental income. And then if in the US the taxes are higher, you will pay the difference in the US, and you will because you will utilize the taxes you paid in Italy as a tax credit against the taxes due in the US.
Mm.
Now, let's take a different example. Let's make a different example. Employment income. And this is one that unfortunately many people miss. There are many people who, from, for example, the US, will go to Italy and continue working. And they don't realize that for employment income, the treaty establishes taxation in the country where the employee or the self-employed lives,
Hmm.
or where the employee or self-employed is a tax resident of. Today, I had a consultation with a couple. They have been living in Italy for years, and they have an LLC in the US, and they are the only members and owners and employees of the LLC. So they had not been filing taxes in Italy because, in their belief, the income was sourced in the US. So it's a US income, the LLC in the US, the clients of the LLC are in the US, and they were paying taxes in the US, and they thought that they were satisfying all the tax obligations for
Hmm.
that type of situation. I explained to them that actually, since they are Italian tax residents because they live in Italy full time and they have a home in Italy, they don't even have a home in the US.
Ah, yeah.
And yes, and they are the only owners of the company, and they are also the only employees. The fact that the LLC is registered in the US doesn't make it a US tax company for Italy. Italy will deem the business being established in Italy because decisions are made in Italy, because the work is performed in Italy, regardless of the fact that the clients are overseas,
Yeah.
and the ownership of the business is in Italy. So these three components, all of them are in Italy. So Italy says, yeah, you can establish your business address in Panama, the US, Cayman, whatever. But if the business is in Italy, you are kind of fictitiously establishing your record overseas. But the business in reality is in Italy. So you have to file taxes in Italy.
Yeah.
And then the treaty also says that employment income is exclusively taxed in the country where you actually live.
Yeah.
So the treaty for employment income establishes not precedence like for real estate, but exclusivity. Does
Hmm.
it make sense?
It totally makes sense. I was totally tracking with you. So let's talk about things like retirement income, like Social Security, like IRAs and that kind of thing. Because that's probably most of our demographic is people wanting to retire in Italy, either full or part-time. Now, obviously, if you come into Italy full-time and you don't have a home in the US, which we'll go over that hierarchy in a little bit, um, obviously you're going to be paying taxes in Italy. And what kind of, how many of those, or maybe all of them, are taxed as income or somehow taxed in Italy? Can you go over that briefly so they know what to expect?
Sure. Yes, definitely. So before we get to the specific taxation of how pension and social security is taxed, let me say that when you think about Italy coming from the US, it is important to keep into consideration that in Italy, income taxes are absolutely personal, meaning it's a personal tax liability. Every individual files taxes individually. There's no joint filing like there is in the US.
Okay.
So that means that each person has his or her own income that falls within his or her personal income tax brackets. Like in the US, it's great to file jointly because when you file jointly, you put everything together and the brackets are much larger,
Yeah.
right? And much wider.
Mhm.
In Italy, if you have a person who makes a lot of money in the couple and the other person who makes less money in the couple, unfortunately, you will not be able to take advantage of larger brackets because the person who makes more money will just be taxed at a higher marginal tax rate.
Mm.
And the person who makes less money or no money will not be taxed at all in that higher marginal rate, perhaps.
Mm.
I don't know if that makes sense.
Yes.
So, what I recommend people before moving is arrange your finances, your estate in the U.S. in a way that you can kind of rebalance your income when you move to Italy. How do you do that? There are several ways to do that. For example, one way, if you're deciding to, I don't know, rent your home in the US before moving to Italy, You can do a quick claim deed and put the property, if it is joint property, in the name of the spouse who has a lower income.
Ah,
So
okay.
that when in Italy, it will fall into the tax return of the person who still have available tax brackets, lower tax brackets, with lower tax rate.
Mm,
And the same goes if you have brokerage account, investment accounts that generate dividends, capital gains. Put everything in the name of the person who moved, or structure it in a way that it generates a flat tax in Italy, which for dividends and interest is 26% and goes outside of the brackets.
ah,
However, now let's go to pension income. So now there are exceptions, obviously. So let's talk in general terms. In general, the treaty against double taxation between Italy and most Western countries, like the US, like I believe also Canada, for sure the UK, establishes that um, when you collect pension income paid from a foreign source, so paid from a US retirement plan or from a US entity, and you live in Italy, that pension will be taxed only in Italy. That's what the treaty says, that
ah,
the pension income must be taxed only in Italy
okay.
because you live in Italy and pension income has that exclusivity rule on the treaty level. However, there is an exception. If you're, and I'm not going to get into all the exceptions, but just the main ones. If you work for the government or for a branch of the government in the US, for example, if you were a teacher,
Mhm.
or if you worked from another government agency in the US, and so you got a public pension, kind of old style pension, old fashioned, I mean, pension.
Yeah.
That government pension um, is not taxable in Italy. The treaty says that that pension is only taxable in the US, in the country where you served to get to accrue the entitlement to that pension. Okay, so there will be no pension taxable in Italy at that point.
Okay, okay, and that
With
covers
respect, yeah,
the public
yeah,
employees. Anybody that gets PERS, public employee retirement benefits or whatever, would fall under that particular thing. And that's all
yes,
military, is that right? Military?
military as well, yes.
Okay.
However, there is an exception to the exception.
Uh-huh.
If you are in that category and also acquire Italian citizenship, then the pension becomes taxable in Italy.
So if you become a,
So the rule is,
okay.
yeah, if you become an Italian citizen, yes. So the rule is pension income is taxable only in Italy. However, it's paid by the government, is taxed only in the US. However, if you are also an Italian citizen, it's taxed in Italy.
Okay.
Okay?
You need a flow chart, but that's fine. I mean, it gives everybody,
I know.
they're probably going, okay,
I know.
okay. So that's good. That helps a
Yes.
lot because there's a lot of questions on, taxing pension income, IRAs, and that sort of thing. Now, you're talking about Social Security, IRAs, all of that stuff falls in one bucket, right? As far as income. Is that right?
Yes. Also, Social Security is follows the same principle. Social Security is also taxed only in the country where you have tax residency. And probably this is probably the time where we might want to talk about how do you establish tax residency?
Yes.
Because many people think that tax residency is established based on the registry residency registration with the commune at
Right.
the municipal level. So other people think that actually you are a tax resident if you live in Italy or if you spend in Italy more than 182 days in a tax year. Let's start from the principle that what counts is actually not really any specific formal parameter, but more the identification, the assessment of where a person has what they call it the center of vital interests.
Yeah.
So the person's center of vital interest is in the country where of which they will be considered tax residents. So the Italian domestic tax system has determined certain ways to identify that some indicators or that might help identifying the central vital interests of an individual. So they will say, if you are registered as a resident at the commune, at the municipality level, for more than 182 days in a tax year, you're assumed to be an Italian tax resident. However, you can provide evidence that you're not. If you are simply registered, but you've been, you know, having your central vital interest elsewhere, you can disprove that formal assumption. The same goes with the 182 days, really. Like if you have been in Italy for more than 182 days in a tax year, and let's remember, it is always the parameter is always within the tax year. It's not 183 days in a row or, every January 1st, there's a clock reset, a
Okay.
day reset. It starts running again. So you always look at January 1st to December 31st in Italy except for when you deal with Germany and Switzerland, which Italy adopts a split here, meaning you can have tax residency split between the countries as you move. But that's very, very small share of individuals probably interested in it. So in general, if you're registered in Italy at the comune level, or if you're present in Italy, physically present in Italy for more than 182 days in a standard year or 183 days in a leap year, you are assumed to be a tax resident. So at that point, you might be actually a resident, or you might think that that assumption doesn't work for you because Italy is not your home.
Mhm.
And what I'm saying there is you might have your home, what you feel being home, somewhere else. So let's talk about, for example, an American who goes to Italy to acquire citizenship.
Mhm.
And many times people decide to go to Italy because it's easier, it's faster, you don't have to go through the consulate, you acquire residency and you skip the line. And within a few months, really, you can get your citizenship and your passport after that. So a lot of people have been doing this. They go to Italy, they register as a resident, and then they stay there waiting for the process to go through. However, uh, they will continue working in the US, and many times they will have also their significant others in the US. They will rent a home in Italy or be with friends in Italy, and they will keep their home in the US. So for US purposes, the US domestic tax system might very well claim that they are US residents because they spend enough time in the US and have enough ties and enough connections that qualify that individual as a US tax resident as well. So you have now two tax codes, the Italian tax code and the US tax code, where both systems claim tax residency for the individual. So the Italian tax code says you've been registered, you're present, you are an Italian tax resident. US tax code says, well, you have X, Y, and Z, you are a US tax resident. So the treaty, once again, will help there because there is a rule in the treaty between Italy and the US, like there is between Italy and many other countries. And usually, Article 4, if you look at the treaty, consistently throughout the treaties, is the one that establishes how to resolve a conflict of dual tax residency.
Mhm.
So a person at a treaty level cannot be considered a dual tax resident ever. So you either are an Italian tax resident or a U.S. tax resident, and the two countries have agreed that must be a thing. Like you can only have a person who is a tax resident of one country,
Yeah.
not both.
Okay.
So the treaty will say, okay, let's look at how to resolve it. So Italy, you say that that's an Italian. US, you say that it is an American tax resident. Let's see the tie-break rules, they call it. So you go through several tests. The first test is, okay, let's look at where the person has a home available to him or to her. So if you in Italy are staying with friends on a friendly basis, you don't really have a home available to you. So that will automatically disqualify the Italian tax residency because you still have your home in the US, we said, in your name, with your bedroom, with your wardrobe, with your clothes and your things where you can go and leave as you please. However, if you are renting in Italy and you have a lease agreement in your name, if the lease agreement it depends how the lease agreement has been structured. If the lease agreement is for 6 months, just the time to do citizenship paperwork and go back to the US, once again, you have a partial year covered by housing. And for the rest of the year, you don't have really a home available to you. So once again, the US will prevail. What happens if you have a full lease agreement for the entirety of the year in Italy and also your home in the US? Well, at that point, you have a home available to you in both countries.
Mm-hmm.
So the treaty says if you have a home available to you in both countries or in neither of them, then we'll look at where you have the center of your vital interests. But that's the second test.
Okay.
So as you see, that we have seen the first test, the home available to you.
Mm-hmm.
Now, the second test is where you have the center of vital interest. And they will look at, so if you are in Italy on your own, enjoying Italy, of course, having a good time while waiting for the paperwork, a fly back and forth a little bit, your center of vital interest might still be in the US because in the US you have your spouse, significant other, children, and so forth. So even if you stay in Italy, as I was saying, we have gone through housing and central vital interest. We haven't discussed the presence in Italy at all, right? So the 183 days is not relevant. So if you can prove that in the US you have a home and you kept your central vital interest, you can stay in Italy for longer than 182 days without kicking automatic and enforceable Italian tax residency because you can still claim US tax residency.
Okay.
If, however, you have you cannot establish where the central vital interest is because, for example, you have with you in Italy, you have a child and you have another child overseas. So you will be, and then you have in Italy some social life, in the US you have other social life. So that becomes also a tie. You have to break that tie and go to the next test. The next test would be, let's look at what you lived the most. So only at the third test level, your presence in Italy becomes relevant when you look at the treaty level. Does it make sense?
Yes. So let's go back to the center of vital interest because we talked about some things, and I think it's very important for people to set themselves up so that in the event, the first question I have for you is, how would a person find out that the tax people are coming after them? Do they get something from the Guardia di Finanza that says, hey, hey, or whatever? And then secondly, how can they prepare to prove that their center of vital interests are in, say, the US? Bank accounts are in the US, investments are in the US. You had mentioned family and church. And, if you're running around and you're not on social media ever, right, which very few people are, what can you do, even with social media? What can you do to prove that your center of vital interests, before it becomes an issue, um, are in the U.S.? What would a group have to,
Sure.
or a couple or somebody? Because there are a lot of people that come over and they spend quite a bit of time in Italy, but their families are there, their homes are there, and everything else. And we had talked about, renting out, a portion of your home in Italy for some period. So let's go over all of those things that you would start and set yourself up so you could prove it if you had to.
Yes, definitely. Yes. So it's important to be mindful and conscious of what potential evidence you can provide to win those assumptions. Because as we said, the Italian tax system will work on assumption, on tax assumptions. And so the burden of evidence is flipped at that point.
Yeah.
It's you have to disprove the assumption. That is a legal assumption. Okay. So and they say that it is a relative legal assumption because you can win it, you can disprove it. So, and it is important to be mindful because audits can happen potentially after 8, 9 years from the tax year in question. Because what happens is 2025 is the tax year. You're supposed to file your tax return in 2026. And if you don't file anything because we are not any time tax resident and they think that you should have, they have 7 years after 2026. So 80 years total since basically 2025 to audit you. And the way they would do it, they would send you usually a letter of compliance, a letter of clarification, questionnaire, whatever. So they might find out based on your lease agreement, your registered municipal communal registration as a resident. There are many ways how your tax profile might be flagged. So our recommendation to our clients is keep your record for 10 years because you cannot get wrong with that. It's easy to remember. Mm-hmm. So what record? You were absolutely right that you want to keep record that will confirm basically your interest in the country where you want to, prove your residency, your tax residency. So definitely keep all your family record that you might have. For example, if you have, I don't know, if you have credit card paying for tuition for children or for car in the name of your children or things like that, or spouse or significant other, all the payments that you make for accounts and interest of people in the US, definitely keep record of all of that. If you send checks for Christmas to those individuals for their wedding, their birthday, things like that, keep record of all of that because and make sure that you download those statements before you change bank because they will delete everything. They will prevent you from accessing from it. And also, if you have checks from your bank, banks nowadays allow you to open up the check online, you can screenshot it. So have all of that. Basically, what I'm saying is if you also have, for example, auto insurance, you have other individuals on your policy, gym membership, if you're a member of any association, church, you mentioned that too. If you make donations to the community or the church you belong to, all of that, keep track of the bank statements, payment, credit card statements. And then if you have a social media account, screenshot it. Why not? Screenshot anytime you go to the US and you go to some event or some function, family functions, screenshot it and keep record of it. Just keep them in an orderly manner in your files because they might become handy. And in Italy, since you most likely will not have a lot of connections because you will not have an Italian bank account, or if you have it, you probably continue to use your cash or foreign credit cards because unless you live in Italy full time, fully committed, you most likely will have way less connections in terms of payments and traceable forms of payments, as I said. So definitely that is one area, like financials. The other area is also if you have a home in Italy where you do not spend the entirety of the year, one very good idea might be to rent it for the month or months when you are not there, possibly. And you don't even need necessarily to, find necessarily a tenant because, I don't know, there might be some circumstances why a property might not be usable because it's a little bit off season or because it's not priced right. However, if you have a listing, if you have a contract with your real estate agent where you say, hey, please try to rent it for me, And
Yeah.
if they cannot rent it for whatever reason, at least you have a documented evidence that you have tried. I've tried, I'm not there, and I'm trying to rent it. So
Oh,
all of that helps in detaching you a little bit from that home available to you. Because once you rent a property in Italy, it is no longer available to you because you are giving up temporarily possession.
that makes sense. So basically, you could also take screenshots of your Airbnb and booking platforms and listings and things like that, right? You got it listed there. That could work.
Yes,